So first of all, thank you all for joining today, taking the time. I am Hemant Gangolia. I am the founder and CEO of iNRI. I am very excited to be hosting this webinar as an NRI myself. I have lived in the US for over 7 years now and have experienced the journey of an NRI very much like all of you today. And today I'm personally excited to host this webinar on US taxation. So as an immigrant, I think everyone has gone through a similar journey of identifying, how to do taxes, whether through yourself or through a CPA, finding the right CPA, and ultimately kind of making the right decisions to save your investments, and save your have maximum savings on your capital. Now, this is not an easy task. It's a lot of trial and error, as I have realized myself, and requires essentially the right guidance, which can generally come from experts or the people that have moved for so long now. So today we are fortunate to have two experts who will be sharing the podium with me today. One is Dinesh Reddy. He is an experienced tax expert, having served more than 1,000 NRI clients so far, and Abishek Batra, who is also an expert CA and a CPA based in Canada. So I'm excited to host them today. And the focus for this webinar is basically going to be talking about US tax saving strategies. I will start with the basic version, 401k, HSA, and but we'll also go to a more advanced version. So with that, let's begin. I'll ask Dinesh and Abhishek to just share a couple of words about them.
Abhishek, you want to go ahead?
Thank you, Dinesh. Thank you, Hemant. Thank you for the introduction. Hi, good afternoon, everybody, and good morning, good afternoon. And I am Abishek Batra. I am a practicing chartered accountant. I lived in India for last 45 years, and I've been practicing as a chartered accountant in India, specializing in taxes for last 25 years, wherein I have been handling all types of clients, NRIs, corporates. And when I moved to Canada, I realized this part of the world that there is a huge vacuum of qualified people who are providing kind of assistance in those NRIs and helping their taxes, who understand both the worlds. Because being an NRI, we have to file taxes in India legally per se. If you are having income, though many people say they don't have income, but technically everybody has some kind of income in India. So this is something which I always feel that we should be filing our taxes in India also, and we find very few people who understand taxation of the both the worlds, but because that is entirely different, especially when your status changes from an H1B visa holder or a work visa or a student visa to a green card. The taxation ambit is quite different from Indian perspective. So I started out on providing services to my clients based out in Canada and US, and now I am helping. And then this year we are helping out clients through an INRI. Dinesh is there, who is also a tax expert. He has been filing return, as mentioned by Hemant. He has filed more than 1,000 returns in last so many years for NRIs. And today we are going to discuss what are the strategies which we can adopt for saving your taxes and maximizing your capital by deferring it or by whatever strategies which are available. Primarily, most of us are aware of 401k, IRA, Roth. These are common terms as far as tax planning are concerned by an individual. But there are a few other strategies which Dinesh and I will be discussing. I would ask Dinesh to start the presentation with starting with 401k and IRA Roth.
Yeah. Thanks, Abhishek. Hello, everyone. Thank you so much for taking the time to join the call today. Just as Abhishek was mentioning, that there is a huge vacuum in terms of accounting experts, especially who understands both the sides of the world. Just to give you guys a picture, in US there are 10x number of accountants comparatively to any other country. Yes, the GDP is high, but also the taxation is pretty complex. Thus, the number of accountants are 10x comparatively to any other country. So, and also, like most of the immigrants, we are all first generation immigrants in the US. First to be an engineer, or first to be a millionaire, or first to be making hundreds of thousands of dollars. and we end up not planning for taxes specifically. But eventually, most of you might be, if you're seeing the screen, you realize that you have a couple of expenses every year that you keep track of. And like most of the tools like Credit Karma already gives visualization on where you're spending the most. But taxes could be one of your largest expense, along with the other expenses that you consider. So because you'd be paying federal tax, you'd be paying state tax, social security, Medicare, including sales tax. So more or less, if you're making $1 million and you're living in a state like California or New York, which has additional 10% of state tax, then you're almost paying 50% of your income in taxes. So as an immigrant, to compound wealth in the long run, it's always useful to optimize your taxes so that you would be optimizing your wealth compounding also. And today we'd be talking about, as Abhishek mentioned, we'd be talking about retirement accounts, which most of you know from Instagram or from TikTok. And you also know about different benefits related to health savings accounts and dependent care and flexible savings accounts. Some things, a couple of people who are itemizing their tax returns have also understood about donations. There's this new concept called donor advised funds, also real estate as a tax strategy, or there are new strategies that are coming into the market since last 2 3 years. Usually the strategies such as solar energy investing, which falls under renewable energy investing, or charitable reminder trust, these strategies are used by family offices who is managing millions of dollars of wealth. But due to the democratization of the internet and technology, these strategies are available to common public also. Overall, it's not that you want to implement all these strategies immediately this season itself. There's this concept called don't let the tax whale wag the dog, which is you don't want to get into trouble by just doing it for the heck of saving taxes. The goal is to understand, like do the due diligence outside in the market also. And if you're really confident that, hey, this strategy might be really helpful for me, then you would want to execute this. So just going into the basics, 401k, I'm sure all of you are already contributing to 401k, but there are still cases where either you or your spouse, although the maximum is 23,500, you would not be maximizing your 401k, but you might be missing free tax dollars, because if your tax slab effective tax rate is 20%, for every $1,000 that you contribute to a 401k account, you're immediately getting $200 tax benefit in the same year. So 401k, if you're thinking in the terms of compounding over the next 35 years, if you're contributing every year $20,000 and you have a little bit of a match from your employer, then the estimated retirement account could go up to $500,000. There are calculators in the market, but compounding plays a huge role when it comes to 401k. There's something that when I'm talking to a lot of clients over the last 6 years, something that I realized is through 401k, you could also take $10,000 out of your 401k without any penalty, in scenarios like you have a firstborn child, or you're buying your first house, or you have any hardship. So this $10,000, I especially see clients when they're trying to buy a house to do the down payment, they're trying to find all the resources. So 401k, the emergency fund, $10,000 is also something that you can learn about. And Roth, the difference between Roth and 401k is nothing but in 401k, you're deferring the tax to the future. When after your retirement, when you're taking the money out, you would be paying taxes. But in Roth, you pay tax now, but whatever growth that happens, you don't need to pay any tax on the growth in the future. There's this famous story. The person who is in the picture in the screen is his name is Peter Thiel. He's the founder of PayPal. You all might have heard about PayPal Mafia. So he's the one who actually accumulated Reid Hoffman, the founder of LinkedIn, or Elon Musk, the famous guy right now. So he has accumulated all these people, and Peter Thiel is very influential in Silicon Valley. And what he had done is he opened a Roth IRA account in 1999, put $2,000 into a Roth IRA account, and he bought the shares of Facebook. The using his Roth IRA account when he's doing angel investing. So that $2,000, multiple thousands of dollars have been $5 billion because he has already paid the tax on his Roth contributions and he invested. In case you're interested in doing Roth and not only contributing in regular stocks, but also startups or any other investments, you could do it using self-directed Roth IRA account. And this is the last slide of the retirement plans. And retirement accounts, you can also open up a traditional 401k account, but your income has to be less than $123,000 for you to get the deduction in contributing to a traditional IRA account. If not, you can also still use a traditional IRA when you're doing a backdoor or mega backdoor Roth. So backdoor Roth and mega backdoor Roth are two concepts that people usually get little confused. So what happens with backdoor Roth is uh, if your income is higher than $163,000, then you are not eligible to qualify to a Roth account, to open a Roth account. In that scenario, you might want to consider a backdoor Roth IRA account where you're trying to contribute the funds into a traditional IRA and you're already putting the funds after the post-tax contribution, and you move the traditional IRA account to the money that you contributed through a traditional IRA account to a Roth IRA account. And mega backdoor Roth, in mega backdoor Roth, in any year, if your contributions of your 401k, traditional, and Roth is less than $66,000, whatever money is the difference between 66 and the amount that you contributed in that year, you could move the money from 401k account to a mega backdoor Roth, into a Roth account using a mega backdoor Roth option. So to explain a concept, for example, that somebody has like more than $500,000 in their 401k account, and they're like wondering, oh, what would be my taxes? Because I didn't pay any taxes, I deferred all the taxes, but now this 500,000 account in the next 10 years would be easily compounding to 700k or 750k, and I'll have to pay the tax, and the tax bill might be high. So if you're concerned about a scenario like that, then you might want to consider using a mega backdoor Roth where you are continuously every year estimating what would be your tax liability and slowly moving the funds from 401k to Roth so that during your retirement you could enjoy a tax-free income. That's how mega backdoor Roth is a useful option. When you're doing a backdoor Roth, you will have to be little concerned about a rule called pro rata rule. Sometimes IRS, if you're not filing your tax forms accurately, then the entire amount that is in 401k, the entire amount will be taxed because of the pro rata rule. And there are a couple of strategies to avoid pro rata rule. And if you're interested, you can connect after this call and we could talk in detail. So overall, these are the retirement accounts where we spoke about Roth and traditional 401k, traditional IRA, and couple of employers also give you Roth 401k option. If you're getting the Roth 401k option, you can consider Roth 401k option also. So that's about retirement accounts. And generally think of using the retirement accounts so that if you're thinking of a wealth compounding strategy, then retirement accounts complement very well with your tax saving strategies. As you see on the screen, after the retirement accounts, if you're thinking from a tax savings angle, then three accounts that you should be aware is health savings account, which is the most priority one. And then you also have a healthcare flexible savings account and you have dependent care flexible savings account. In case you have kids going to daycare or you have your parents who are going to an elderly care, then you would be able to take $5,000 from your employer and avoid tax on that $5,000. So again, if your effective tax rate is 20% on $5,000, you're directly saving $1,000 of tax by using it in the right way. One disadvantage between dependent care and healthcare FSA is that you cannot roll over the funds to next year. Whereas in a health savings account, you're able to roll over the funds. You can contribute in health savings account $8,300, and you will be able to invest also that money. You are getting a direct tax deferral. You don't pay any tax on the 8,300 that you contribute as a joint family to your health savings account. And so $8,000 and your effective tax rate is 20%, then you are immediately straightforward saving $1,600 in taxes using a health savings account. The health savings account is considered called a triple tax advantaged account because you're avoiding the tax immediately when you're contributing the money, and you can also invest using a health savings account. And after your retirement 59.5, when you're taking out the money, the growth plus the initial contributions both are tax free. So it's the second advantage. And the third advantage of a health savings account is you can backdate your medical expenses, receipts, and take the money. For example, in 2025, you have an injury and you are putting out-of-pocket expenses of $5,000. You can directly use your health savings account card and pay that $5,000. But instead of paying it now, you can wait for 5 more years, maybe invest in any stock. And if you are investing $100 today, and in 5 years, that investment will become 150 or 130, and you can backdate the expenses of 2025 in 2030 and get the money back. So you have three advantages. One is initially you're deferring the taxes using a health savings account. You're able to invest like a Roth IRA account using a health savings account. And the third is you can do the backdating of expenses. So you have three advantages using a health savings account. Whereas dependent care FSA and healthcare FSA, the money doesn't get rolled over. In healthcare FSA, $600 get rolled over, but not much than that. So HSA is considered to be the most preferred option and a powerful account. You can also watch YouTube videos where you might find that people recommending that health savings account is useful than a 401k or a Roth account. If you want a personalized advice, we can chat after this call. And like retirement accounts and health savings accounts are flexible, or these accounts are the basics in terms of taxes. In case you are not itemizing, then those are the strategies that you have. But if you're itemizing your tax return, which is you've got a standard deduction, if you're filing joint, your standard deduction is around $29,000. So in case your itemization is higher than $29,000, then you are eligible to take itemization of the tax return. So when you're doing itemization, generally in my 6 years of experience, when I've been filing taxes to 1,500 people, especially people in Silicon Valley tend up to take advantage of goodwill receipts. They try to donate anything waste in the house to a goodwill and collect receipts for $5,000 to $10,000. And as soon as you're trying to take donations, as soon as you're trying to donate $5,000 to $10,000 to Goodwill or to any temples or any religious institutions, you can itemize the entire amount in your tax return. So you're decreasing your taxable income. So for every $5,000, assuming again your effective tax rate is 20%, then you're directly saving $1,000. So donations to charity is a useful strategy in case you're itemizing your tax return. Other than donating to charity, there is this new concept of donor advised funds. And you can use donor advised funds in case you're having a significant tax bill of around $500,000 or $1 million in a scenario where you made an income of around $2-3 million. Then you can set up a donor advised fund where you donate specific amount of money to a donor advised fund and take immediate upfront deduction from your taxes. So, for example, you have contributed $100,000 to a donor advised fund, you are immediately getting upfront deduction of the $100,000 from your taxes. And using a donor advised fund, you would be able to invest, and whatever growth that happens, even that is also tax free. But the only disadvantage with the donor advised fund is you have to contribute all the money that you've put in donor advised fund to a charity of your preferred choice. In the end, after during the end term of the donor advised fund, you will have to contribute the entire money to charity. So you can divide it in this way, which is donor advised fund is an advanced strategy where you would want to do simulations by consulting with professional firms like iNRI, and then decide whether you want to do a donor advised fund or not. But donating to charity and itemizing your tax return is very basic. So if in case you have a mortgage and you're paying mortgage interest every year and your itemization is higher than the standard deduction, then you should be doing charity donations and take the advantage in your tax return. So we've covered donating to charity to itemize your tax return and decrease your taxable income. We've covered healthcare savings accounts or different dependent care accounts. These are all that will decrease your taxable income and will also help you to decrease your tax. And we've also covered the retirement accounts. So the retirement accounts, health savings accounts, and donating to charity, these three are basics of tax strategy. In case you go to any tax consultant in H&R Block, Jackson Hewitt, or even in YouTube, right? These things you'll find, and these are the basics to save on taxes.
Yeah. Dinesh, before we move forward to the real estate part,
Yeah.
I just want to emphasize and tell you the fact that 401k and a traditional IRA plan, there is a basic difference that 401k is employer driven and traditional IRA plan wherein we have a smaller limit of $6,500 is any income, self-earned income. It should be an earned income, not passive income. If it is an earned income, and if you want to have if you are self-employed, you are having your S corp or something like that, then you may find that you cannot have a 401k because there is no employer attached to it. So in that scenario, traditional IRA plan is an option available with a lower limit. The only caveat with the traditional IRA plan is it is for the low income people, because as you earn more, the amount of 6,500 gets reduced, and beyond $163,000 it gets to zero. So initial period you may go for a traditional IRA, but if you have a 401k plan, then the best part is something is your employer is also going to contribute. So whatever you are earning tax free savings on your tax, but apart from that, there is a equal contribution or matching contribution, which may be 50%, depending upon your terms of employment. There will be a contribution by the employer also in a 401k plan. And one thing more, which I'd like to emphasize, is that HSA and retirement accounts, they are mutually exclusive. A person can have both of them, a health saving account as well as a Roth 401k or IRA account. They are mutually exclusive. And one of the things which is important is HSA is basically to cover up your medical emergencies. And it has a lower cap, where in case of IRA, there is a limit of only $10,000 as an emergency fund. In case of any emergency, medical emergency within your family, HSA is the best tool where you can get the money immediately. Because in IRA, you will have to wait till 59 and a half to withdraw that money, apart from that emergency fund of $10,000. So these are a few things which you have to keep in mind. And HSA, as Dinesh already mentioned, is one of the best tools which is available for saving the taxes. Primarily, it's more of deferring the taxes initially, and then you have to employ deferred strategies to different strategies wherein you can save the taxes permanently. Yeah, Dinesh, we can go ahead with that.
Yeah. And you can also have all the accounts like HSA, dependent care, healthcare FSA. You can have all the three accounts. You can have 401k, you can have Roth, and you can also use backdoor Roth. So it's not that if you're doing one strategy, you cannot do another strategy. Abhishek?
Yeah, we can do that. That's what I was trying to emphasize. These are all mutually exclusive. We can have multiple accounts, and we have different options available with them. So depending upon each person's individuality, it can, if somebody is in the early 20s or early 30s, so he would like to go with HSA. First, he should maximize his HSA, then move ahead to other plans, because the waiting time for getting money out of IRA is much more longer than in a HSA. HSA, you may require it for any kind of a medical emergency. You may meet a small accident or whatever it may be. You can get that money immediately. So that also it's more liquid, I would say. It's easier to get the money from an HSA account than from an IRA account.
Yeah. And especially if you're in your 20s, then you should also consider a Roth account because it does wonders in terms of compounding. If you're contributing every year, like even $8,000 and it's growing at 10%, or with the current equity markets, it's growing higher. So the compounding really works and it's magical. So people who are young can also look into investing Roth very early on so that whatever growth that happens, it's all going to be tax free. Yeah. So
Yeah.
Abhishek and Hemant, do you guys want to answer the questions related to retirement accounts now, or we'll cover all the questions in the end?
Yeah, let's cover it later. Let's finish the
Yeah.
presentation.
So guys, like whoever has joined little late, just to give you a recap of the basic tax strategies, you have 401k, which is the basic 101, and everybody, if your employer is matching or contributing, then you should not miss on 401k account until where you're getting a match. And after 401k, you have a Roth account where you might be paying taxes right now, but whatever growth that happens is completely tax free. And then you have backdoor Roth and mega backdoor Roth. And backdoor Roth you would be using if you're unable to qualify for a Roth account because of your income limits. In mega backdoor Roth you would be using in case you want to move your funds from 401k to a Roth account. And you also have a different benefit plans, but such as dependent care FSA, healthcare FSA, and health savings account. And as Abhishek mentioned, health savings account is something that everybody should prioritize. In case you have a high deductible health plan, then HSA is not a miss option account. And in case you're itemizing your tax return, then you can donate to charity and increase the itemization of your tax return. And after covering the basic strategies, we'd be talking about advanced strategies. And real estate is a tax strategy where everybody took advantage until there's a recent tax changes. But most of you or some of you who joined this call might have a long-term rental property somewhere in the US and you're collecting the rents. And every year you file your tax return. In your tax return, you have your income that you received as a rent, and you have mortgage expense or insurance expense or other expenses. And more or less, after taking the depreciation, you're seeing a loss from your rental property investment. But the problem is, whatever loss that's coming from your rental property, long-term rental, you are unable to offset it with your active income. So active income is your W-2 income or any income that you are earning by actively involving. And you have a $200,000 active W-2 income, and you have a loss of $50,000 from rental income. But you cannot offset the $200,000 minus $50,000 directly because IRS requires you to offset only active income with active loss, and you cannot offset your active income with your passive loss. So to become an active real estate investor for long-term rentals, IRS requires you to contribute 750 plus hours to qualify as an active real estate professional. So like if you have multiple properties or single property, things like commuting, fixing things, talking to a landlord, or validating the land, talking to a tenant, or validating the tenant's credentials, managing the entire property. If you're spending 750 plus hours and you have losses coming from the real estate, then you would be able to offset it with your active income. And in depreciation also, you have this concept called bonus depreciation, where you can take 80% of the depreciation in the same year instead of trying to take it over 27.5 years. And 750 plus hours is very high to manage one, two rentals. People might say that, hey, I can't show 750 plus hours. Then there is this concept called short-term rental. And in short-term rental, to qualify as an active investor, you only need to contribute 250 plus hours. Whereas in long-term rental, you are contributing 750 plus hours. In short-term rental, you are only contributing 250 plus hours. So short-term rental any rental will be qualified as a short-term rental if the average length of the duration of the stay is less than 7 days. So Airbnbs or hotels qualify as short-term rentals, and again, you would be using depreciation, bonus depreciation to decrease to increase the loss in the whole rental property. And there's also another concept called cost segregation. So using cost segregation, you're not just depreciating the property, but you're also depreciating the items like HVAC or bulbs or any other items in the house. And even when you depreciate them, then your losses will be more. But the real catch is to qualify as an active real estate investor for short term or long term. A lot of people used to take advantage of the real estate in the US for their taxes. Previously, the number of hours were less to qualify as a real estate investor. As more and more people started taking advantage of real estate as a tax strategy, IRS came up with this new rule of 750 plus hours for a long-term rental and 250 plus hours for a short-term rental. And you also have 1031 exchanges. For example, you have a property that you are selling and you have gains from it and you want to avoid the tax. You can set up a 1031 exchange, move the funds to a 1031 exchange, and buy a property that is of equal value, of higher value, and you avoid the entire capital gains tax using a 1031 exchange. There's also 1031 liquid exchange, which is an advanced strategy where you don't want to invest in a property but take out the liquid cash. In that scenario, instead of paying 20% capital gains to the IRS and state tax, you just pay 7% to the broker by executing the 1031 liquid strategy. And opportunity zones, right now, according to the regulation, it's ending in 2027. But how opportunity zones investing works is whatever capital gains that you get by selling a stock or by selling a real estate or anything, instead of paying the tax to the IRS, if you invest in any qualified opportunity zone, then you don't need to pay any tax until 2027. We're already in 25, so I'm not sure how effective it would be for anyone who joined this call. But if you're thinking about using real estate as a tax strategy, then you want to learn about how to qualify as an active real estate investor for short term or long term. And you also want to learn about cost segregation analysis. And that is the main thing that will decrease that will show extra losses in your rental property. So that's and also another thing with real estate is I think most of you are already aware of this rule that if you're selling your primary home and you have lived in the primary home for the last for 2 years in the last 5 years, then you don't need to pay tax on the capital gains. There are specific numbers involved with it, but if you're selling your primary home, then there's another tax strategy. I'm sure a lot of you have been seeing people who have built real estate empires uh, talking in TikTok or on YouTube, and that's how they do it. So that's real estate as a tax strategy. Moving on, the next two concepts that I'm going to talk are more or less new. Investing in renewable energy projects is something that started from 2022, 2023. Biden administration launched a new policy called Inflation Reduction Act, where they started giving tax credits for investing in renewable energy investing. So to take an example of a Google employee who has sold a stock of $500,000, he or she needs to pay on $500,000 if they're living in San Francisco Bay Area, then they have to pay almost 50% in taxes. So their tax bill is $250,000. So instead of paying $250,000 to the IRS, they can go and invest in a solar energy project. If they're investing $100,000 in a solar energy project, then they get $140,000 in tax credit. So you're actually making 40,000 more by considering a renewable energy project. So there are two structures in renewable energy projects. One is called leaseback, and the another one is called flip partnership. So the difference between leaseback and flip partnership is you can see on the screen in a solar leaseback option, you are putting in $1 million. Usually, the investments in renewable energy starts from $100,000, but I'm giving you an example of if you are putting in $1 million, then you get $800,000 in tax savings, and you also get an income of 3 to 7% over the next 25 to 30 years. So there's a lot of pushback from the marketplace where investors started telling that, hey, we don't want to keep up the risk of this investment. What if the governments change? What if the policy changes? Then I don't want to have this headache of tying up with this project for 25, 30 years. Then for those kind of investors, there's a new option called flip partnership, where you put in $1 million, you get around $1.4 million of tax benefits, and you don't get any income from the project. So that's how flip partnership works. And renewable energy projects are going in high scale. People are still investing. There is a concern that what if Trump administration cancels the IRA rule? But according to the IRA, you cannot change the legislation until 2027. So there's still option until 2027. And if you're interested in learning about renewable energy projects, then we would be happy to schedule a one-on-one call and understand whether you actually should do renewable energy investments or not. And the last one is the Charitable Reminder Trust. So Charitable Reminder Trust is a concept where you're again working with a Google or Apple, or you already are significantly invested in stock market and you have gains of $500,000 or 100,000 or $1 million. So let's take an example of an investor who have a stock portfolio of $1 million, and he's trying to liquidate the entire stock. So if we are liquidating $1 million stock, then if it is long term, then you would be paying 20% capital gains. And if it's short term, then you would be paying your normal tax rate. And in a short-term scenario, you're almost paying on $1 million, you're paying $500,000 in taxes. So what is the option that you have to avoid the tax on the capital gains? So Charitable Reminder Trust is a great option where you are taking the money, you're moving the money from your brokerage account to a trust where you would be the beneficiary of the trust and your kids would be the beneficiary. And once you move the money into the trust, then you can sell the stock that you wanted to sell. As soon as you sell the stock from the trust, you're not triggering any taxable event, and whatever money that is left in the stock after you sold, you can keep reinvesting in any asset. That asset can be real estate, or that asset can be stock or anything. You can keep reinvesting, and again, you can keep selling, and you're not paying any tax when you're doing the transactions from within the trust. And when you would be paying tax, that's the number one question, right? How do I take the money out and when do I pay the tax? So you can take the money out in distributions yearly. Every year you can take up to 11% in distributions. And whatever distribution money that you take out, you would be paying in tax. You would be paying tax on the distributions that you take. There are calculators available for the trust. How much would be your savings? And usually, if you're putting in $1 million, then you would be taking home $1.6 million using a trust, versus you would be just taking 500,000 or 600,000 or 800,000 back home, depending upon the tax slab that you have. So Charitable Reminder Trust has different types of trusts. The one that I'm showing on the screen is Charitable Reminder Uni Trust, but you also have Charitable Reminder Annuity Trust, and there is revocable trust and irrevocable trust. But if you are having high stock income or high capital gains assets, and when I talk to a lot of real estate investors in the market, their biggest problem is they're sitting on a bunch of commercial properties all across the US, but they don't want to sell the real estate because they'll trigger the taxable event. So for those kind of people, or a stock market investor who has a lot of stock that is not yet sold, and he or she is worried about triggering a taxable event. In a scenario like that, and you can move the entire funds or entire portfolio into a reminder trust and then play around it so that you are paying less in taxes. So just to give you a recap, we spoke about advanced tax strategies such as charitable reminder trust. We spoke about renewable energy investing, where in renewable energy investing, you have two options. One is lease back and flip partnership. And we spoke about real estate as a tax strategy, where we mentioned about active and passive and how to qualify as an active real estate investor. And these three strategies, renewable energy, reminder trust, and real estate, are the advanced strategies. Whereas if you're itemizing your tax return, then you should be considering donating to charity. And if you have more interest in charity, then you can look into options like donor advised funds. And after that, then the basic strategies are health savings account and different flexible savings accounts. And we have retirement contributions. Over to you, Abhishek and Hemant.
Yeah, thank you, Dinesh. And it was lovely understanding few new things and everything. And it must be new for many people out here. One thing which I would like to mention regarding the charitable reminder trust is the fact that is a tool which can be used for taking your assets for your family without any liabilities. You are just moving your assets from your personal liabilities to a trust, and it remains there for a trust, and the beneficiaries, which may be you and your family members, it does not get affected by your personal liabilities, which may arise or which may not arise. So it's a tool which has been used by many HNIs in the historically, wherein they have move the assets from their own personal holdings to a trust, and then ultimately it goes to the beneficiaries. And it's a tool wherein you save on the estate liabilities also. So that's a tool which can be used, charitable reminder trust, not only the tax liability, immediate tax liability, but it also the tax liability for your future, which is going to be there. And regarding the renewable energy, it's a big it's a lot it is a there's a sizable investment which is involved in it. It's a complex strategy, but very good strategy, wherein we can save a lot of money and lot of taxes. And real estate, the only caveat is that it has to be an active real estate investment. It cannot be a passive real estate investment. Most of us Indians feel real estate as a passive income, but we have to manage it in an active manner. Then only the exemptions and the benefit of taxes are available. If it is not active, ideally you have to spend number of hours. Basically, like Dinesh has explained, there are two types: short-term rentals and long-term rentals. And what is the time amount? You have to explain that this is the amount of hours which you have spent, and that's how you become an active real estate investor and claim the benefits. That's all, I guess, from the taxes and tax saving strategies. Hemant, we can now take the questions.
Yeah. Okay, so before we go to the questions, first of all, I want to thank Dinesh and Abhishek for sharing the insights. To be honest, some of these things are also unknown to me, and I'm happy personally to learn about them today. I also want to share a disclaimer. This is an educational webinar, so some of these points may or may not suit you, or you want to consult an expert before understanding, if this is applicable. Um, Additionally, I also want to share that iNRI is a ERS e-file provider, so we are authorized and approved by IRS to now file taxes. And with this webinar, I am excited to also share that iNRI is now uh, helping US persons or NRIs file taxes. So imagine, let's say, TurboTax for NRIs. We aim to be that solution. So starting today, we are offering this service at an introductory price of $69. This includes W-2 and 1040. And rest assured, your filing will also be done, with tax experts like Dinesh, Abhishek, and we are also adding more as we speak. So more updates to come on this soon, but wanted to take this opportunity to share about this upcoming product on iNRI. I will share this more details as an email post. I are also recording this session, so we'll also be sharing that very soon later today. Now with that, let's move to the Q&A. So, Abhishek, there are some questions that are asked to me personally, I mean, like on direct message. So let me moderate the Q&A and ask you some of that as well. Okay. So please feel free to use the Zoom chat if you haven't put in the questions, and we'll try our best to answer them. Now, the first question is, does it help to invest in Roth 401k versus 401k? And if you plan to move out of US to India later? Dinesh, Abhishek, anyone?
Yeah, I
Can
can take
Yeah.
this question. So
Okay.
I think this has been very significant thing in the NRI community, right? which is when I talk to a lot of people who want to, like, just to put it in a different perspective, the generation who is coming to US, most of us want to go back, and we plan everything in terms of going back. So the most frequently asked question is, hey, I don't want to do a Roth or a 401k because I'll be moving back to India. So if you move back to India also, the rules are the same. Uh, you have to wait until 59.5 to take the money out without penalty. But think of dollar to rupee conversion, right? So the number might be really high. So you're compounding your income, whatever you're putting in, even US stock market in comparison to India works bet the same way or sometimes better depending upon your portfolio. So you cannot take the money out. If you move to India also, you are investing to your retirement. Either you invest in India for your retirement or you invest in US for your retirement. Hey, Abhishek, you
Yeah,
want to add
Dinesh,
anything
as
on
you
top
mentioned
of it?
correctly, it's the objective. You have to determine what is the objective of your investment. When you make an investment, whether it is Roth, IRA, whatever, you always have to set a goal. Investment is always goal based. If you are having a goal that you need the funds after 5 years, then there is no point discussing about IRAs and Roth, because you are Roth and IRA are basically retirement tools, the retirement saving plans. So if you are planning to go back in India, you are at the age of 50, and after 10 years you are planning to go back in India, yes, it's a good tool. But if you're in 30s and you are planning to go back to India and say, I might need it. I know people who have moved back to India in last 1.5 years when I came here. They have gone back and they are still continuing to hold their Roth or IRA accounts because they don't need the funds right now. And one advantage where probably there's a question also on this, whether what happens, can somebody take the benefit of it as a RONR? Yes, you can take the benefit of a RONR. The moment you become a non-resident of US and your status is RONR in India, your income is to a certain extent not taxable in US. The sale of equity shares and all those is not taxable. So you can take advantage. It all depends on the situations. There cannot be a general answer for these kind of questions. But yes, you can take advantage of those. And whenever you are planning for your retirement, then only you invest into Roth and IRAs. Otherwise, it can be tricky. You end up paying taxes at a higher rate. Today you are paying at saving at 20%, and tomorrow you are in a higher bracket, or you withdraw the money, you end up and paying taxes in a higher bracket with along with 10% penalty. So you need to strategize and plan what is your goal. Yeah.
Yeah, great point. I think just want to emphasize the investment should be based on goals and not, and also the timeline. That is key to understand, like, should you invest or not. Can we touch upon tricky scenarios like withdrawal of 401k by a person who decides to return back to India? Is there a way to minimize taxes? A similar one, but any different thoughts?
There are hardly any ways we can minimize the taxes, but the only way is that when you move out of US, your income will go down in US. Your income, depending upon your visa status, if you are not a green card holder, you came on H-1B visa, you are not liable for your global taxes. Then there can be a possibility, or you can withdraw in a later years.
Mhm.
Then you would be having lower income in the initial year, later years, so you won't be taxed much in US. Like, for example, if somebody is making $200,000 annually and he decides to go in 2026, I want to go back to India. In 26, he will not be making $200,000 in US, and he withdraws from Roth or any other account. The taxability will be on a lower side because your income would be at the lowest level. So these are a few strategies which you can plan, but immediate withdrawal would be a taxable affair, and it will be an expensive than what you had planned initially.
Right, right.
So also one thing that has I'm like 33 years old now, and one thing that I can share about my personal scenario is that investing is always long term, right? And using this, if you're just trying to touch 401k or Roth or HSA investing other than your healthcare, if you're thinking about these three accounts, then you're just investing it for long term. You're not thinking about short term. You should not be thinking about, yeah, tax, there is advantage for sure, and we are all building wealth for long term. But once you start investing couple of thousands of dollars, then your entire investment mindset might change. That, hey, okay, this is 30 years or 20 years. I'm 33 now, so I have like 27 more years. Then I would be calculating in terms of compounding mindset of how much this money would become after 27 years or 26 years. So you cannot be like thinking like, oh, I would still do Roth and be like, oh, I want to take the money out after 10 years. Uh,
Mm,
and these amounts are also very less. It's not like you're putting in significant percentage of your income yearly into these accounts. These are like minute percentages, and you have that flexibility on how much you want to put in the money, and you want to do it for the long term versus doing it for the short term when you're just thinking about the retirement accounts. And the concern that what if I move back to India, what will I get my money back? You will get your money back. You just have to maintain the active account, and you all know how transparent US is comparatively to other countries. So based on until now, there is no cases that somebody moved back to India and they weren't unable to take out the money from their retirement accounts.
yeah. So I think Dinesh, you answered the next question. So there was someone who asked, should you, if they move to back to India and if they don't contribute to, let's say, I mean, their company doesn't contribute to 401k, but should they contribute? I think it's again a personal question, and also to be more thought from a long-term perspective. And imagine like this is a retirement account and not a general investment account that you look to redeem out, let's say after 5, 10 years. So if you are just thinking of short term, better to obviously go for a brokerage account and have more liquidity, right? Compared to going for a retirement
Yeah.
account.
And it's a financial planning question also, right?
Mm,
Again, you want to dive deep into financial planning also. If you're thinking about what would be the implication if I'm withdrawing the money in 5 years or 10 years, then you would again want to go back to your drawing board and see what exactly are my goals and plan accordingly.
yeah, yeah. Okay, I think this is quick question. I also am not aware, but you could answer. HSA, can HSA amount be used in only US based health expenses or India as well? I guess not India, right?
Yeah, so you better talk to the HSA provider where you're opening the
Mm,
HSA, like HSA Bank or different HSA providers. Ideally, yes, it's US based, but still, you can still confirm with your HSA provider. I'm not sure the person who is asking this question, do you already have a HSA account, or you're thinking about opening a HSA account?
One thing which I would like to say is that you need to have a HSA account. There was a question that if somebody is not having an HSA account and they have expenses in
HSA.
India and they can claim that, backdate that. First, you have to have a HSA account. Then only you can claim the benefit of the HSA. And there are qualified expenses which are allowed in case of treatment, whether it is in India or anywhere. It's not mandatorily treatment has to be in US. Depending upon the situation and the facts, the answer may be different. But there are qualified expenses which are eligible. The biggest caveat is they should not be covered under any insurance. It should go out of your own pocket. The money
mm,
should be spent out of your own pocket. If you are they are covered under any kind of insurance or any kind of a medical plan, by whether it's employer, personal, whatever it may be, then you will not be able to have any benefit of HSA from that.
mm. So related question on HSA, in what scenarios can you withdraw apart from health expenses? So not counting health expenses, what else can the money be drawn on? Or there is no other option?
Yeah, only you can take the money after you're 59.5. After your retirement age, you can take money for anything. You can just take the money out like a normal account, but until 59.5, you will have to use it for only health expenses.
Right.
Dinesh, please tell about the taxability also about that.
So you
Uh,
don't need to pay any tax once you're taking the money out after 59.5. Whatever growth that happens in the account, all that money is tax free. So you can think of HSA like a Roth account if you're doing investing.
Mhm.
it's a pre-tax Roth account.
Yeah.
Yeah. So
The
definitely a
features, I mean, it's
important.
not called Roth, but it's the features of
Yeah.
the HSA account is like you have 401k feature, which is you are not paying any tax on contribution. So you're directly not paying, avoiding whatever your effective tax rate is, and you're letting the money compound. And today's $8,000, most of us in this call are engineers, I guess. And today's $8,000, if it is growing at 10% or 20% for the next 20 years, you could assume what would be the number be, and you don't need to pay any tax on the growth. You are completely avoiding the tax.
Yeah. So as I understand,
That's the one
one
more
must
reason that we should always try to maximize our HSA.
yeah, yeah. Yeah, that's what I was saying. Like as I understand, like one must definitely have an HSA. Quite a
Yeah.
lot of features and
Yeah.
taxable
The only
scenarios.
catch with HSA is if some people end up having a low deductible health plan and you are not eligible to
Mm,
have a HSA account if you have a low deductible health plan.
mm. Okay, there was one question I think someone asked later, but want to just touch upon because we're
Yes. So
talking
the
about HSA.
HSA, Vikrant, withdrawn for, yes, you are right, Vikrant.
Yeah. Okay. So I think again on the India side, yeah, I mean, from an Indian taxation, can we take advantage of R-Nor? So I think we talked about this, that one can take it. Um, how to identify the ideal proportion of 401k and Roth 401k?
Uh, uh, I take this one, Dinesh, regarding proportion of the investment in between both the plans. It is entirely an individual subjective answer to the situation, because at what stage of your life you are and what is the goal of your investment. That is the primary factor which is going to determine what kind of proportion you are looking for. So if it is later in the stage, later in you are in 50s, I would suggest go into Roth 401k, because then you are going to withdraw much sooner. And if you are in the early 30s, small portion may go into 401k initially, and you will get an equal contribution from your employer or matching contribution, some kind of matching contribution, and it will save you taxes, and it will grow, compound over a period of time. You are giving much more time to compound, and it's always the compounding which helps you in the long run. So it all depends on a situation. There cannot be a ready-made formula that I can say 10-20 or 10%, 90% here, or 20-30, 20-80 or something like that. But it all depends. What is your income levels? What is your age? A lot of things are involved in it.
Yeah, that's fair. So moving on, will medical expense? I think this is already asked. Um, pre-tax. Yeah, can we have both healthcare FSA and HSA account?
Yes. You can have a dependent care FSA, you can have healthcare uh, uh, FSA, and you can have a HSA, you can have a dependent care flexible savings account, and you can have a health flexible savings account. The only disadvantage is remaining two accounts, they don't get rollover. So you are
Mm,
contributing 5,000 and 3,000 in both the accounts, but the money is
mm,
not being rolled over. So in case it's like credit card, right? Like American Express Blue Platinum card, you have to spend $8,000 to get the 150,000 points. So we are
mm.
in a rush to spend that the money will not get rolled over. So ideally, yes, you can have all the three accounts.
Okay. I think a similar question after that. What is the max limit one can contribute into IRA as well as 401k pre plus post combined? Um, if and I think there's also mention of different limits, 7,000 and 69,000. So if once someone reaches that, then they still contribute to a traditional IRA. Asked by Anita. Dinesh, any
I,
thoughts?
I didn't get the question.
Yeah, quite a detailed question. Can you refer to this one with by Anita? So what is the max limit one can contribute into IRA as well as 401k combined? And if someone reaches a $69,000 limit, then they still contribute into traditional IRA.
Okay, okay. No, the maximum is $66,000. All the retirement accounts, including your employer contributions, Anita.
Hmm. So you can't like club all of the limits and then have a higher limit essentially, right?
No. Yeah. So in that, Anita, it depends on your specific situation. So we can set up one-on-one maybe sometime this week through Hemant. where we can go over your specific scenario. Because when it comes to contributions and moving, whatever advice, whatever knowledge that we shared in this call is more of a very high perspective, and every person's situation is very customized. So we can go over your situation over a one-on-one call so we can better understand.
Got it. Okay. I think this was already answered. So in healthcare FSA, you don't get the carry forward, only in HSA. Um, I think this question is already answered, that can we contribute to HSA now if not enrolled in open enrollment? So yeah, you can't do it. Okay, so in case of an accident, when we use HSA, can I claim insurance? And should I deposit that money from insurance back into the HSA?
Yeah, this is subject to the HSA provider, so you might want to shoot it this one to HSA account provider.
Okay.
Ideally, it's the money which you pay out of your own pocket. If it is covered by an insurance, so HSA withdrawal would not be. You cannot have from best of both worlds.
Hmm.
It has to go out of your pocket.
That's the reason I asked
That,
you.
this is the
Contact
primary
the
condition, I would
HSA
say.
provider
In,
because they might be able to better explain
yeah,
you.
I understand that. But fundamentally, principally, it should be the money which you have spent out of your own pocket.
Hmm. Okay, so to claim backdate health expenses, is it necessary that I have an active HSA at the time of expense? So question is like, if they start now, can they really backdate previous expenses or not?
No,
No.
you cannot.
Okay.
So, for example, you can, if you're starting your HSA account in 25, after you open the account, you have any medical related expense and you don't want to use your HSA card because you're putting your money to invest so that they grow. So you're waiting for the next 2, 3 years to let the money grow. And in 2028 or 2030, you can backdate the expense of your 2025 medical receipt. But it only
Yeah.
starts once after you open the account.
Got it. There's this question asking me on DM. So can I offset loss of rental property from gain in stock market?
Yes.
So
Yes, you can.
is there nuance on active or passive income or no?
Yeah.
Uh, yeah.
Go ahead, Abhishek.
Yeah, you can go ahead.
So, like, you cannot, like, even the stock income is considered to be an active income. It's not passive income. So, you cannot offset it until, so you cannot do anything with the real estate losses until you qualify as an active real estate investor. If not, you can only offset with your rental to rental or you have another passive income
Hmm.
coming. So, it does not, you cannot do it with the stock.
True. So yeah, you can take advantage of both HSA and FSA as shared. Um, can I contribute to traditional IRA after maximizing 401k?
Yeah, if you're maximizing your 401k, you can still contribute to a traditional IRA, but if your it will not be tax deductible if your income is higher than 123k. But you
Okay.
can,
Okay, so you're just contributing to IRA, but there's no tax benefit if as
yes,
long
if
as
your
the
income is higher than 123.
yeah. So,
Specific income limit, I can check and tell, but yeah, no problem.
mhm.
Yeah.
Got it. So just to understand, I mean, this won't be helpful because one is contributing to an IRA, which is a retirement account, and not getting the back benefit as well. So doesn't make sense to contribute if you are above the limit.
No, it's helpful if you're moving to Roth.
Okay. Understood.
But
Um,
the point here is that what is the
hmm,
objective of the investment?
hmm,
If taxation is only the objective, then it is not
Then
helpful. But if you are investing to for your long-term goals,
hmm,
yeah, it can be advantageous.
right, right.
you're right, Abhishek.
So, okay, I think this is more on India side. What are the tax implications of investing in equity mutual funds in India, the US, and NRI? Do we need to pay taxes after redemption, or should we report them annually? If the amount added to our gross, adjusted gross income, then if yes, do we need to pay 12.5% in India and an additional 20% for those returns in the US? Abhishek,
You will have to pay tax in India. Whatever tax you pay in India, that 12.5%, which is the current rate, if you are redeeming or gaining. So whatever you pay in India is adjusted against your tax liability in US. There is no doubt that whatever you earn in India is reported in your taxable income in US, and it may add to your taxable liability in US. But the benefit of tax which you have paid in India is also available in US. So you end up paying additional 7.5% if you're in 20%. Then you have to pay 7.5% more to the US government.
please mute yourself. Okay. So one thing I want to share, like we are already at time, and we do have any questions, so we'll answer as many as possible as time permits. But I will share some resources on the chat. So these are some webinar resources. So we have a tax filing for NRIs provided by iNRI. You can go to this to learn more. We also have a US NRI group. You can join there, and finally you can email us at tax@gonri.com for one-on-one consultation or so we'll continue answering. Thank you. Okay, so just scrolling up. Yeah, can NRI buy farmhouse in India?
It depends on the state laws where you are buying the farmhouse. In some states, agricultural land is not allowed to be purchased by NRIs. So you have to check with the respective states.
Cool. Is renewable energy investment strategy applicable only when we invest large amount like $1 million?
Yeah. So Vignan, pretty good question, Vignan. The renewable energy investments, as of now, with the vendors that we are partnered with, they have like $100,000 as a minimum investment. But somehow I'm hearing that like energy as a strategy is changing for US and China. So US is competing heavily with China in terms of energy because of the AI and all boom. And I think renewable energy investments will increase more and more, regardless of how much we go on to nuclear and thermal and different energy things. So right now, the minimum investment is $100,000, but it might go down in future. It might come down to $50,000 or $30,000, but as of now, you have to invest minimum $100,000. So you would be considering renewable energy investment if you're paying more than $150,000, $200,000 in taxes. Then yes, you should be learning about renewable energy investing.
Please mute yourself if you're not speaking, Sharad. Okay, so my employer allows HSA account only when I choose a high deductible plan. Do the benefits still way better with the HSA in spite of the high deductible plan?
Yeah, Shubham answered the question.
Okay.
So, and then Abhinash told how to invest in Roth IRA and who should invest based on salary. So, yeah, anybody can do Roth, just that you cannot directly contribute to Roth. Abhinash, if your income is higher than 160K, then you might want to use a backdoor Roth option, but still you can qualify to contribute in Roth.
Got it.
And Roth is not employer sponsored, so you can go to Robinhood and open a Roth IRA account also, and you have more flexibility to invest in any asset comparatively to 401k. Kaushal, I'm a dental professional. I pay fee. So Kaushal, you might want to do a one-on-one consultation with Hemant with me or Abhishek, because we want to understand if you're doing a dental practice through an LLC or through an S Corp or a C Corp, and depending upon your business structure, the taxes might change. And Sharath, what about if your gains are in India? How can optimize long-term gains in India? Abhishek, you want to answer this?
Yeah, there are a lot of ways where we can do that. Probably we have to understand what kind of gains it is, whether they are equity gains or they are gains from sale of real estate and all those. So depending upon those, we can plan out or we can optimize. Ideally, what is one basic viewpoint generally people have is, what once we have paid taxes in India, then why we don't have to pay tax in US? You have to come out of that. Yes, you have to pay tax in US also if you have gained in India. So US, at least in case of those who are having green cards, they have to pay tax globally across the world, even if they don't live in US. They may go back to India, then also they have to file the taxes and pay taxes on the global income.
Yeah.
Okay.
And then, Mittal, will there be a session on how to manage India taxes while being an NRI? How to report India earnings in USA taxes and managing TDS? So, Hemant, the question is to you. Will there be a session?
Okay. I think I was just looking at the moderation. Could you please repeat?
Will there be a session on how to manage India taxes while being an NRI? How to report India earnings in USA taxes
Yes,
and
yes,
manage?
yes, yeah. Yeah, we plan to do more webinars this season. So 2025 season has just become for US, and so we will do more of these in the coming weeks.
Yeah. So Sri mentioned about 5 to 9 plan. Sri, we were supposed to talk about 5 to 9 plan, but we didn't want the content to be overflown. That's why we didn't carve 5 to 9 plan. But 5 to 9 plan, you can only use it for your kids' education, and once you can use from their K-12 education or their undergraduation to cover their dorm expense or tuition fee or stuff like that. So you cannot use the 5 to 9 plan other than the education. But if you are thinking of doing something for your kids, then you can also think of a custodian Roth IRA account for your kids. That is one more product that's coming into market lately. So, Anu, could you please talk about LLC and benefits? Anu, Abhishek, what is the answer for LLC and benefits?
LLC, basically one of the most primary thing when you make a LLC is that you are moving away from the liabilities. As far as taxation is concerned, ultimately the taxation may not be much savings in the taxation, but the primary factor when deciding whether you have to have a S corp or LLC is depending upon the fact how do you want to shift your liabilities. So, because ultimately, if you want the money in your hands, then you have to pay tax. If you create any other kind of entity, you are just deferring or postponing the tax. Advantage, like there was a case question regarding a professional doctor. So if he's having his own corporation, then yes, he can claim all the expenses, whatever he has mentioned, itemized deductions and all those, because that's a separate expenditure altogether to earn that income. So I would say having a LLC is, tax is not, should not be the objective of saving the taxes while creating a LLC. You should determine what is your ultimate objective, whether you want to have more people attached to yourself, you want to go get yourself listed, or what is your long term objective. Taxation, ultimately you have to pay taxes if you want money in your name in your bank account. If
Yeah.
you are comfortable having money in some other's name in some other bank account, though, and you are the owner of that, controlling that account, then yes, these all strategies, whether it is charitable reminder trust or it is LLC, whatever it can be a good tool.
So, Anu, to add on top of Abhishek, US tax code is rigged for real estate investors and business owners. So, if you are getting thoughts of opening up an LLC, very good. But it's
Mhm.
very, very individualized, and we can have a chat maybe one-on-one to understand what exact goals do you have with LLC and business, stuff like that. But yes, if you want to optimize taxes, then there's this famous saying that US tax code is rigged for business owners and real estate investors. And Sharath, I received your message. We'll follow up. It's a DM direct message. And then Mittal, do you guys have team to help file India taxes for iNRI, including support to visit local tax offices to help resolve any disputes? Hemant, this question is for you.
Yeah, we do file India taxes as well. However, we don't have like local or like tax office as such. So everything is online, but it's very much available on video or call or otherwise. Um, and we have filed more than 100 taxes last year, just for Indian filing.
Cool. Pramit, where can I find more about 1031 liquid? I'll follow up with you, Pramit, on 1031 liquid. And I'm not sure which part of the US are you in. If you're in the Bay Area, then we have vendors that are in the Bay Area where we can arrange a one-on-one meeting directly with a 1031 liquid
I
vendors.
appreciate it. I'm in the Bay Area, yes.
Yeah,
So yeah,
cool. Yeah.
appreciate it.
So we could connect and do it. Yeah. And I guess Hemant is hosting an in-person event also in the Bay Area. So we can catch up then also on
Sounds
1031.
good. I'll try to make it for that one. Thank you.
Yeah, yeah. And Arnab, I'm on J2 visa and this is my first tax filing. Do you guys help J2 visa holders to file taxes? Yes, Arnab, we do help you. We'll need to understand what exactly your income is and other things, but yes, we do help. How much does it cost for filing additional state, Jai? Hemant, you want to answer this?
State would be roughly $49 extra. We are still finalizing the pricing, but it would be roughly around that number. And it also depends on other forms, like if you have investments, dependents, so additional fees will follow. This would be similar structure where you have, let's say, with turbo tax and otherwise, but definitely be assured that it would be very competitive and something that is more personalized to you.
Yeah. And Vignan asked that can we use HSA for supplements, gym members, swimming classes, gymnastic? It's subject to provider, Vignan. Like every provider is trying to come up with new benefits. So once check with your HSA provider on what exactly can be qualified and what cannot be not qualified. So it's pretty much transparent to you. Anil, how many returns did you file in USA last year? Anil, personally, I've been helping more than 1,500 people, and we also power a couple of accounting firms. And Abhishek also filed hundreds of returns. So if you have questions, then we can do a one-on-one call and go more. PP in HSA account, if you invest in Roth, then whenever if you have medical emergency, then can we get that amount which are invested? Yes, you'll need to sell that and take the money out. If it is already invested, then you will have to sell and then take the money out, PP. If it is being invested without selling, you cannot take the money out, right? Pretty logical. And Sachin, can you shed some light on how to report gains, losses from stock brokerage account in India on US 1040 return? Abhishek, you want to take this?
Yeah, it's a normal. It's a foreign income which is earned, and if you have losses, then it's deductible like normal losses in US. There's no difference. You have a capping of $3,000 and all those. If you don't have any other income, capital gains income, then you will not be able to adjust beyond $3,000. So it's normal. There is no difference basically.
So, yeah, Anil, is your tax filing service, do you include accounting for Income India? Yes, Anil. And link giving 404, we'll fix it. Is it,
Yeah, I think I missed
yeah.
on the link. I've updated the link or
Mittal, the question again, 401k, if you're moving, withdraw 10 years, do I need bank account in USA to get that money? You can just check with your IRA provider, Mittal. We are just talking to you from the tax angle, but yes, I think you can do all of it, but still check with your provider. Can we withdraw from 401k to keep within taxable limits for the tax year? Something like pseudo. Not sure about your question, Vignan. Do you have answer for this question, Abhishek?
No, I am not able to understand.
And do I need to pay taxes in India for money which I am withdrawing from 401k?
Yeah, yes, you have to pay taxes in India. It depends upon what stage you are and what status you are at in India. If you are a resident out there, then and if you are non-resident, it depends on that. One thing is there that you may save upon taxes in US if you're a resident in India from your 401k withdrawals, because 401k as per the double taxation avoidance agreement are treated as pension income. And when at what stage you are, if it is a pension income, then it is only taxable in India and not taxable in US. There may be a situation that you may have got tax deducted upfront while you are withdrawing from your IRA or Roth, whichever the account is. And when you withdraw, you get the money after deduction, then you have to file your taxes and claim the refund for that.
Yogesh, when can I start withdrawing money from Charitable Reminder Trust? Is there an age or time limit? Yes. Charitable Reminder Trust, Yogesh, it can be a webinar on its own. It's a one-hour topic. But you have different types of trusts. Usually, the one that is preferred by immigrants is Charitable Reminder Uni Trust, and it's set up for 20 years. So you would be taking 10% to 11% every year from the trust as distributions, and you'll be paying tax on the distributions as ordinary income. And there is no age limit. The time limit is the time limit that you set up for the trust. 20 years is the average trust time that people usually set up for. Manas, if we change employer and new employer not providing HSA, contribution stop to HSA provider. So in that case, should we withdraw the amount? You can still open a new HSA account and move the previous funds to a new HSA account, or you can keep contributing to that HSA account if you can get access to it. Is IUL better than 401k? Kumar. Abhishek, do you have an answer on that?
I'm not able to understand what exactly.
Yeah. So I can answer, Kumar, but it's very personalized, Kumar. People my clients who are invested into IUL say that they didn't grow well because it's indexed, not variable. So it's very personalized depending upon what strategy you are considering. People who seem to be happy with IULs in my customer list is the ones who have actually diversified they have 401k, they have IUL, they have everything. So IUL is one form of a strategy for you. You cannot compare both. If you want to compare, then it's very personalized to your situation, Kumar.
Dinesh, just a quick something for the audience. Like, could you define IUL just so that people can refer later?
Yeah, it's an index products, right? So it's like, yeah.
Okay.
Can you go on the other questions, Hemant? What deductions can you take from there?
Yeah. So, what are options if someone accidentally contributed $6,500 to Roth IRA without taking into account income limit consideration?
Excellent to
Uh,
contribute to Roth IRA without taking into income limit considerations. Yeah, I mean, it's kind of like tricky. Like if you have done directly to a Roth IRA without taking, it's very personalized, Sandeep. Like, did you file the tax return that year? Which year? What happened? Maybe if you can give us some context through a one-on-one call, we could advise you clearly. Anil, does your service include e-filing for both federal and state?
yes.
Hemant answered. HSA with fidelity. How does taxation? Yeah, go ahead, Hemant.
Yeah. How does taxation work for income generated in India? I think we already answered this. Do we need to pay taxes on unrealized gain, and how does taxation work for sale of MFs or mutual funds? Abhishek, you have any
Yeah,
thoughts?
any income which is earned in India is taxable in US if till the time you are a US tax resident, and though you have to pay tax in US, whatever tax you pay in India on that income is deductible against your tax liability in US. You get foreign tax credit according to the treaties. There is no double taxation. As far as mutual funds are concerned, it's a quite tricky situation, because Indian mutual funds are considered as passive foreign income company PFIX, and there is a special treatment of taxation for that. You have to file separate form 8621. There are different methods. It's altogether a different topic which we can have separately. Hemant, you are aware of that PFIC is such a complicated topic. And so yes, to simply say yes, you have to pay tax of that. If you earn income in India, you have to pay tax in US. Whatever tax you pay in India is adjustable against your tax liability in US. You get the foreign tax asset. There is no double taxation, though, at least. So, but yes, you have to pay higher tax. In India, there is 12.5% tax. In US, you have 20% tax. So you will pay up 20%. So yes.
Great. So the HSC can be withdrawn for non-medical expense after 59 and a half. I think yes, right?
Yeah.
Okay. What deductions can I take against my primary home besides mortgage interest?
Nothing. In your tax return, if you're for your individual, other than the sale of the home, you cannot take much. Abhishek, is there anything other than
No.
the mortgage interest? Yeah.
Okay. If we are in India after 59 and a half, when we withdraw the 401k, are we taxed in India then?
If you are a tax resident of India, you are taxable only in India.
No, but if they are withdrawing this 401k after 59 and a half, will they be taxed for that distribution?
If it is a Roth, there are two things. One we have to understand, if it is a Roth IRA and we are withdrawing it, so there is a component which is a contribution after the payment of taxes. That is not going to be taxed anywhere. But
Mm,
whatever the gains you have made on the distribution, whatever profits you have
mm,
made, that is taxable in India
mm,
because it is a capital gain and there is no concept of Roth, and there is no tax-free concept in India like we have in US. Anything you do after 15 and a half from your Roth account is tax-free, but in India it is not tax-free. Let's say you invested $100,000 today, and later on when you withdraw at the age of 60, it was 500,000, and you are a tax resident of India, so you may end up paying taxes in India.
got it. And this would be on the cost basis, so 400K would be taxed. Is that right?
Yes, yes,
Yeah, okay.
400K will be taxed.
Okay, so can you talk about pass-through tax deductions for real estate investment? I saw it in the slide, but I don't believe you covered it. Any pass-through tax deduction, Dinesh?
Pass-through tax deduction for real estate. Uh, I mean, so real estate, again, to re-emphasize, like if you're taking it against your primary house, then you would be using it in your itemization in Schedule A so that you decrease your taxable income. That's one thing. And the second thing is, if you are doing it as a rental property, then you will have to qualify as a long-term or a short-term real estate investor to offset the gains. This is the second one. And third one, the real estate that you are talking, is it a rental property or you're referring to an investment that you made as a limited partner in any LLC in a real estate investment? The third one might be the question that you're asking. For that, you'll have to be a general partner, not the limited partner, to gain any advantage. But generally, from a real estate perspective, there's nothing called pass-through. So
Hmm,
if you clarify your question better, maybe we can answer.
okay. Can I use HSA for my spouse and children? If yes, the coverage applicable.
So HSA contributions, if you're contributing single, then it's only around 3,300, something like that. But if you're doing it for family, then it's 8,000. And yes, you will be doing it for the whole family.
Yeah. Okay, so for tax filing, does iNRI include state tax? Yes, yeah, we will help in state tax, W2, 1099, K1, FBAR, FATCA, even PFIC. So imagine like this should be your to-go solution for NRIs, like anything relates to both US side as well as India side. Are you sure we can have all three HSA and FSA? I think we answered
Yes.
that. Yeah. Yeah, we will help in filing state taxes as well. Uh, I have had bad experiences to the by here in USA where their company called a call center in India who helps in it. Yeah, so we don't do any selling of data or random soliciting. This is quite a professional area that we work on, and it's we highly regard customer interest as well as the privacy with respect to data. Is travel insurance we buy from Insu or parents covered in HSA? So
I
can
don't
we
think
yeah,
so, but you can still check once again with the provider.
okay. If I'm unemployed this year, can I contribute to IRA this year using my savings from last year?
Yes, you can contribute.
Okay. Apart from tax planning, do you provide tax planning advice as well? Yeah, we can do that.
So Aftab, I'll expand, double click on this question. Tax filing is a very simple thing, and you can do DIY or like tax filing is not a very complicated thing, but tax planning is really important, considering that all of us are ending up or will be ending up paying 50% or 40% in taxes. So it's always good to plan taxes. And Abhishek points it, double clicks on this very well, which is you don't want to do anything wrong just because to save taxes. You want to do it in the right way so that it's not actually affecting you negatively.
Mm,
Instead, it's appreciating your strategies. So tax planning is really important if you're having income from RSUs or ESPPs, or you have stock options, or you have real estate, or you have multiple LLCs, or the more complex it is, the better you should be doing tax planning. So yes, we do help with tax planning, and we also help you create a personalized plan which will help you to pay if you have to pay quarterly estimated taxes also, so that you're not ending up paying any penalty on taxes.
Okay, so next question is, are there any deductions for mortgage interest paid in India for a home loan, and the tax deduction is for the US?
Abhishek, you want to answer?
It's only for US. Whatever interest you pay on the Indian home, it's not your primary residence. You get deductions only against your primary residence.
So what if it's on their name and their parents are staying in the house? Still no, right?
No, it has to be your primary residence.
Yeah. There are situations where people just do it for the heck of doing it, but that's not the right one. Yeah.
The primary condition of claiming any tax benefit from your primary residence for interest on housing loans is that it has to be your primary residence.
Mm. Yeah, good point. And I think fairly misunderstood one as well. Can this be done 23,000 split in traditional Roth 401, 23,000 as IRA? Dinesh, you understand this better?
Can this be done 23,000 split in traditional and Roth 401? 23,000 in Roth IRAs, traditional IRA won't make sense. What other contribution can be made after this? So just to answer, like, you have 401k, you have Roth, and then you can do mega backdoor Roth if you want to move the funds from 401k to Roth. So you can contribute 23,000 into your 401k account, and Roth you can contribute 6,500. So this is how much you could contribute from your money into retirement accounts. On the top of it, you can use a mega backdoor Roth in case you want to avoid tax in the future.
Okay. So what are the charges for one-on-one consultations? So if it is like I think quick, we can do it for free. This is again a early pricing for just a webinar participant. But if it involves a bit more planning, requires to give some extra guidance, then definitely we can. I mean, the pricing will depend on the expert and the level of effort. Um, any issues with PDT trading
So
in US? Yeah, Dinesh.
no. Go ahead. Sorry.
Yeah, so any issues with PDT trading? I'm not aware what's that. Dinesh, are you?
PDT trading in US stock markets, any limitations or risks? Even I am not. There's one mark-to-market election through an LLC that people do trading, but PDT trading, I'm new to that topic.
It's I think pattern day trading.
What trading?
Pattern day trading. There's something like.
Okay, then you will have to be aware of the VOS sales and all. For that, if you're
Hmm.
eligible to open up an LLC and do mark-to-market election, then that's a different strategy. But on H-1B visa, not sure. You'll have to consult an immigration attorney for that. Is there no
Yeah.
tax on capital gains from Roth IRA investments? Nope. And HSA has 3 level of benefits. Can I withdraw this money after 59.5 for non-medical expenses? Yes, you can withdraw the money after 59.5 for anything without paying any tax. And, can you cover Ravi's question, Hemant?
Yeah, is PFIC tax on mutual funds is applicable to H1B or only GC? So it is applicable to everyone who are US tax residents, irrespective of their visa status.
Jai, higher study expenses for self, if you are paying any interest or any tuition fee, then you get a tax form from the university, and you could use that to optimize your taxes, depending upon your visa status and what qualifications and all. But yeah. Are you filing CS state taxes? Hemant, you answered. Hemant answered. Thank you. Any more questions, Hemant?
Yeah, I think this is on 529. It says like he was able to use a 529 for expenses, how I
That's an
understand.
answer. Yeah.
Okay, okay. For someone who just got green card, is there a specific tax filing strategy for the first year?
There
How
is nothing
do,
specific as such.
yeah, I
The
mean,
only disadvantage it would be that you have to file taxes till the time you hold your green card now. No matter where you are staying, whether you continue to stay in US or you go back to India or wherever you are.
Great. And you can connect with us at tax@goNRI.com or start the process on the iNRI platform. Yeah. Is HSA account employer sponsored? Could someone open this account with separately with Fidelity, Robinhood, or other providers? Dinesh, Abhishek.
I lost the question. I was reading
Okay.
a question.
So the question is the HSA account has to be employer connected or is it like sponsored or can it be opened separately?
Yeah, you can open it separately, but you need to have a high deductible health plan and you need to qualify for a high deductible health plan. I have customers who opened it separately, Fidelity. Yeah.
Okay. Thank you. Okay. We spoke about Arnor. Is LIC policy considered PFIC as well? Do we need to report LIC in FBAR? Abhishek, you could answer.
Yeah, it depends what kind of policy it is. If it is a term policy, then it is not. But if it is a investment link policy, then yes, it can be considered as a PFIC.
Okay. Can we have a separate webinar on PFIC and its taxation? Yes, we plan to do some a webinar, as I said, in the coming week. So this would be likely on Indian income and how to report that in the US. This will include your interest on fixed deposit, savings, mutual fund stocks, and even FBAR FATCA to include. Can we get SSN money back if we move to India before turning 59 and with 40 credits while being an Indian citizen? So SSN is the social security, I think the tax that we pay today, is that, can we get that back before we turn 59? Abhishek, Dinesh,
I've never seen such a situation, so I'm not in a position to exactly answer this.
Okay. Dinesh, are you there?
What's the question?
So can we get the social security taxes paid today if we move to India after turning 59 and we have like 40 credits?
I'm not aware of that question. Yeah.
Okay.
It's
So
dependent. The better they consult the Social Security office or someone like that, or do some. We can do some research and answer, but I have not come across a client who has a situation like that.
got it. What's the process to talk tax planning? So tax planning, reach out to us at tax@goinri.com and mention in the webinar resources. How much do you charge for US tax filing? So we charge 69 to begin with. That is includes your W2 and 1040 filing, but additional would be included as per the complexity. I am on H1B, wife is on L1. Can we file joint taxes? Yeah, you could file joint taxes. And yeah, I think maybe Dinesh, you could touch on this. So what is the advantage of joint filing if you are married? Like just share quick points there.
Yeah, the tax slab would go down. Like you can go and check the IRS tax slabs for married filing joint. If your the income limits might be, if your income is higher also, still your tax slab would go down. In case you need help, then we can do a simulation whether you're filing separate or you're filing joint, which one would be beneficial. Yeah. So sometimes it saves, but most of the times filing joint is always the best option. But if you still want to understand, then we could do a simulation and explain you what are the how are the numbers changing exactly to your specific scenario.
Yeah. Is annuity income in India taxable while filing taxes in US? Abhishek,
Yeah, your global incomes are taxable in US.
Okay. Does iNRI offer any investment advice to help manage investments in an IRA? So we don't provide this currently, like investment or like advice on securities yet. If I have 500K in my 401K, I don't want to withdraw all of it once. Instead, can I withdraw only 5K per month and stay on lower tax bracket? Is there a way to kind of do this? Like
Samparna,
withdrawing,
saying that I don't want to withdraw all of at once. So are you above 60, Samparna?
I guess not, like seeing the
You're
picture.
under 60. Based on your image, you look pretty young.
No, Dinesh, this is the follow-on question to something that you could not understand the question. Meaning, if I do have a significant contribution, let's say 20 years later or 25 years later, and if I, when once I retire, if I want to withdraw from my 401k, if I do all of that at once, if I'm not doing the Roth, I have to pay tax, right?
Yeah. Yeah.
So when I pay tax, I don't want to pay tax on the whole surplus of 500k, 400k, whatever the amount is. Rather, if I know my expenses, I know 5,000k, 6,000, 5,000, 6,000 per month is sufficient for me. So as long as I am withdrawing a certain amount which is sufficient for my sustenance, and if I, as long as, can I use the tax bracket to my advantage in this scenario? Is my
You
question.
you can.
The Sampana, I just explain you the concept. The IRA or traditional Roth, whatever you may go for, the concept is the fact that you withdraw only partially every year. After attaining a particular age, in case of traditional plans and 401k plans, there are minimum required withdrawals which you have to make. That you have to withdraw this much amount every year and you have to pay that. But it's not necessary that you have to withdraw the entire sum together. You can do whatever you want, however you want, but there has a minimum cap after attaining a particular age limit. It's not like that everything is going to be taxed in the very first year. So you can withdraw 100,000 in one particular year. Next year you want more money, you can withdraw more than that also. Or if you want less than that, up to the minimum amount required, you can do that.
Thank you.
Okay, I think we talked about mutual fund. Okay, so I think we are done with all the questions now.
Yeah,
Looks like.
Ravi sent a direct message how to reach out for tax planning services. Ravi, you could just email to tax@goNRI.com and we'll respond back to you.
Yeah, one thing I would like to mention, I can already see some emails coming to us on tax@GoNRI, so that's I think a great thing.
Yeah.
Right on the webinar, we have some of these emails already come to us.
Yeah. And Amit sent me a direct question. How much do you charge for tax return filing? Hemant, you can answer that.
Yeah, I'll just share the screen again and maybe talk about it quickly. So we are launching tax filing today. iNRI tax filing. We are an IRS authorized e-file provider. And we help with filing on W-2, 1099, your small business income, K1, real estate, FBAR, FATCA, PFIC. Think of it as a one-stop solution if you are an NRI particularly and want to kind of take advantage of maximizing your refunds, taxes, as well as you have India income and want to kind of report that. We start at $69. This includes the W-2 and 1040. Any other thing, let's say state, if you have investment accounts, brokerage accounts, FBAR, FATCA, those will be add-ons and the pricing will be subject to the total number. And we will share that, when we have the documentation. So you can start for free. You don't only have to pay when we are filing. So the process is like this. You tell us about yourself, answer basic questions, upload your tax docs. You don't have to fill it anything. This is not a DIY. This is a full service solution. So you just have to upload your docs and add some basic information. The tax expert gets to work on it. We'll let what is the requirement, or I mean, in terms of payments or any other documentation that we need. You can connect with them as needed, and then ultimately we prepare and you can approve the return, and then we file. Before you file, you have to pay the final amount, and that's how this works. Okay, there are also FAQs here. You can go and check, or feel free to reach out to us on chat. We can answer more questions here as well. So we'll share all of these links today after the webinar as an email post. Feel free to also share with your friends and in the NRI network that you are part of. Okay, so I think we have
one thing which I like to mention to many people who were concerned about going back. there is a major change which is going to come probably on 1st of February, where in India, the concept of resident NOR, which we have so far in India, may be gone with. So if you are planning based on your consideration of RONR status, everything will change after 1st of February. It's very, very likely that the concept of RONR may come to an end on this 1st of February, next Saturday. So don't
Yeah.
plan anything considering that you have RONR status. I know people who have planned those things, but they may end up in a situation they will have a different implication altogether.
Yeah, and to also touch lightly, because Abhishek mentioned of the webinar, the budget. So we plan to do a budget webinar as well. This will be likely in next couple of weeks. So do subscribe to our calendar. We do more of these events on tax, on iNRI, and more importantly, the NRI audience, and I mean the problems around that. Okay. So with that, thank you everyone. First of all, taking the time today. We are almost at 12 p.m. Pacific. This was the longest webinar that we ever had. So thanks for staying over. Almost 50, 60 people stayed over. And thank you, Dinesh and Abhishek, more importantly, for being here and available to the audience and sharing valuable insights. I also found them very important, and I'm sure, this tax season, I plan to implement some of them for sure.
Yeah, thank you so much. And thank you, Himanshu, for switching on the video. And Pramit, thank you. I think Pramit left. And nice seeing you guys.
Thank you very much.
Thanks,
you.
everyone.
Thank you
Have
all.
a great Sunday. Hope you all have good biryani. Thank you.
Yeah. Thank you, everyone. Thank you.
Bye. Take care.
Bye.
And if you are in the Bay Area, we'll plan to do a in-person also. We'll share more of that again in the email. But
So you need to
thank
give
you.
us free biryani then, Hemant.
Yeah, so we'll have some. We'll definitely have some refreshments. So rest assured of that.
Yeah. Thank you, guys. Thanks so
Bye.
much, Hemant,
Thank
Abhishek.
you. Thank you. Thank you,
Bye.
everyone. Bye.
Thank you.